Hello there, this is Bob from Trade Genius. Welcome to our education series, Learn to Trade and Change Your Life. This is the first course, is an introductory course of how to trade. And what you're going to learn in this section is really what is the stock market? How does it work really? What are the rules? What are our indicators? How to put this all together so you can trade. I'll give you a sample trade plan and then we'll sum it all up. Let's get started. So what is the stock market? At the highest level of stock market, it is an auction. Okay, there are buyers who think the price is below value, so they're willing to bid on stocks and ETFs. And then there are sellers who think price is above value. And in addition to that is that traders are all working off of different time frames. So everybody always asks themselves, well, if everybody kind of knows what's going on, why would prices ever move? It's because some people are trading just for the moment. Some people are trading for 10 years from now. And some people are trading to protect other things. So that's what keeps the market in motion and allows for people to see value differently than other people. And the stock market is composed of public companies that basically have sold shares, private shares to the public, and they receive cash from the public for those shares. They're basically what they call they're monetizing their investment of their labor in by bringing it to the public market. And then once those shares are out there in the public market, other people can buy them and sell them. And so it gives the management and the owners of the company a sense as to the value of their company because there's a lot more people trading their shares. Now you can have stocks or you can have what's called exchange traded funds or notes. And these are a collection of publicly traded companies that share a common purpose. There could be an oil ETF. It could be a small cap ETF. It could be a gold ETF. It could be a minor ETF. It's by sector, by companies that pay dividends. There's a whole slew of options available to you. So it's a really nice tool to use ETFs to help you manage risk or to give you broader exposure to a sector without having to know everything about every little company. And it's not like a mutual fund where there's the restrictions that you have with mutual funds and taxation and things like that. ETFs eliminated that. And at Trade Genius, we preferred exchange traded funds over individual stocks for the reasons we just discussed. It's that you have broader exposure, you have less risk, you have less company risk, and we see it in the market all the time where the minor ETF are doing fine, and then a minor blows up because they decided to go to the public market and sell more shares to the public. Well, the value of the existing shares has gone down, but the ETF doesn't notice it so much. And so those are the reasons why we like ETFs. It just gives you a little bit more stability in the trades that you're working on. And I think a big risk a lot of people take is that they always try to hit home runs, and you end up striking out. And where an ETF is that if you're just grinding out singles and occasional doubles, you're going to make a lot of money. So there's just no need to really chase individual stocks unless there's certain personalities that you like and you're comfortable with and you can trade and you have a good sense for them. And we have a few of those at Trade Genius that we like to follow. There's over 4,000 stocks trading on the big board. And there's over 15,000 stocks that trade what they call over the counter. They're too small for the big board. They're pink sheets. They don't pass the restrictions required by the big board to be listed, and so they trade over the counter. And we stay away from those. Those are the penny stocks. Those are the stocks that get momentum traded and then get the rug pulled out from underneath you. You'll make plenty of money staying in the big boards, and you'll make plenty of money doing ETFs over the big board. And there's 4,300 ETFs anyway. So there's plenty to choose from. You just need to choose ETFs that have a lot of volume. The stock market is valued at over $19 trillion at the end of last year, and is trading at a multiple that is higher than the GDP of the country, like 127%, just to give you perspective. And and over time, the stock market really can only grow as fast as the GDP, and there's a little factor in there for how much credit's being pushed in. And so when you see a stock market that's growing faster than GDP, or it's even worth more than a GDP right now, which is unusual, it's because it's being fueled by credit being pushed into the system worldwide, and including the US, and coming into the stock market. But over time, it just simply does not perform faster than the economy over the whole, because it's simple physics. You just can't. So when you see a market that's pushing up way up higher and faster than the market, that should give you some caution. When it's selling way below the growth of the GDP, that should give you optimism. So just understand your climate you're dealing with. And we just talked about there's three inputs to the stock market. There's credit, there's earnings, and there's productivity. And banks will lend credit to investors and companies that speculate in the stock market. Central banks will create credit, to buy shares in the companies themselves. And we're seeing this worldwide right now. The Swiss and the Japanese are the most transparent about what they're doing. The ECB is buying bonds. And they do this because they're buying real assets, and they're devaluing their currencies, and they're doing it for trade reasons. Okay? And they'll do those things until you get a point where your input costs exceed your ability to sell your product, and that usually corrects currency manipulation. And then, and when businesses, are seeing these virtuous cycles, they're gonna increase their cash flow, which helps the value of the stock market and increases the value of their shares, because that's really what people are looking at. When you give somebody your money to get a share in a company, what you're really saying is that you want to receive the benefit of the increasing amount of cash in which these companies will create. And over time, no matter all the earnings manipulation they do, over time, the value of the company is based upon the value of the future of the cash streams that it's able to produce. So short-term things can look crazy, but in the long term, everything will come back to how much cash is it able to produce versus your other alternatives in terms of putting money in a mattress, or buying real estate, or buying your own business, or paying down debt. So those are all alternatives to putting it in the stock market, and companies have to, their cash growth has to exceed that in order for them to earn, the value of their company. And that's why it always comes back to GDP at some point, because, there's only so much credit, there's only so much GDP, and GDP is a reflection of activity. So if you have so much credit, there's a lot of activity, it's going to generate more GDP, opportunity for the stock market to rise. But as it contracts, then the whole thing will work in reverse the same way. So we just talked about this. It's really the level of the cash earnings it produces. There's an expectation of the growth rate of that cash, and the other thing too is that cash, when people are looking out in the future and say, what, you heard the old wimpy thing, I'll pay you Tuesday for a hamburger today. Well, if he was going to pay you Tuesday 5 years from now, then he's going to have to pay you more money, because it's, the dollar value today is worth more than the dollar value tomorrow. And that creates what's called a hurdle rate. So when companies are increasing their cash, it's important to understand how fast they're going to increase it over time, because that's how it gets valued, and that's really called discounted cash flow analysis. And that, which generates what they call an expected or a fair value price. Now, traders look at that. If a company is trading for less than fair value, they're going to first want to understand why. Is there something that's not being anticipated? Like, for example, a company may be trading below its fair value of what they said they're going to do in cash flow because there might be pending litigation, or there might be pending legislation, or there might be a political risk in another country where they have operations. So it's always more than that. And that's fundamental analysis, and that's all fun, and I spent a lot of time in that arena, but I prefer the wisdom of a lot of investors, and that's why we like technical analysis, because it gives us the input of all the traders, not just what management is saying or select analysts are telling us. And and just to to kind of give you a sense, of this auction, in summary, is that there's always a battle between value and price. So if price is over the value, the perceived value, you're going to find more sellers, and you're going to find buyers if it's the other way around. And then there's another thing, what I would call interest or disinterest. You'll find accumulation if people are interested in this stock, even though maybe the value's not there. There's might be an anticipation, and an example of that is that people know that in the summertime the price of gasoline goes higher because there is more driving, but the value may not be there for people to buy it based on value, but the people might be accumulated in anticipation for that rise later in the year. So that's why you have to kind of look at both things. Is there a reason to be interested or disinterested? I'll give you another example. In the political environment, if a politician that has the power to make the change is out there saying that, what, I'm going to tax this industry. President Obama did it in the coal industry. Okay, President Trump is talking about building walls. So all of a sudden people are not interested in the coal industry because President Obama put a marker out there. People may not be interested in Mexican currency because President Trump is saying something. Even though the value might be there, you may not have an interest level. So that's why I always look at both things, and you have to kind of just be aware. But the market kind of helps you understand that. And we just talked about these things again. So, world news, economic news, change in perception, competition for other investment. This is very important, and I think this is what's driving like the markets today a lot, is that we've kind of lifted up a level. Just not just companies anymore. Now we have sovereign players involved. Those are the central banks and countries' sovereign wealth funds, and they operate on a totally different level because they have different rules in which they follow, and so they may create value that, if you look at it from a company standpoint, it may not be there. And you're seeing that in the stock market today. And this investment this series is in February of 2017, where the indexes are moving up quite nicely, but underneath the market there's some turmoil, is because the central banks, the yield that you receive on a set of dividends from companies within an index is higher than the cost of them to create the currency. So they're going to continue to buy those companies or those indexes as long as they can get a positive yield, because they can use leverage and basically free money because they're creating the currency. So you have to be aware of those things too. And at some point those things tip, and gold is a classic example of being very sensitive to what's happening with currencies. And so you have to be aware of the relationships. Gold and the yen seem to have a very strong relationship to each other. Real estate, especially REITs in our stock market, have a very strong relationship with what's happening with interest rates, because that's their cost input. How much is it going to cost me to carry these mortgages or these construction loans or these commercial loans that we have to take? And then for investors, demographics important. When you're young, you're just trying to accumulate living assets. When you're a young adult, you're, buying a home. And then you get into your sweet spot demographically till basically 40 to 65, where you're accumulating stock for growth. And then as they get over 65, people are using that money to live out the rest of their lives because they're not generating any income anymore. So you have to be aware of that in as well. So these are the competitions to the stock market. And you as a student of trading have to kind of know where you are, what's the investment climate I'm in, so that you can be leaning towards the right sectors and the right trading instruments. And the interesting thing about it is that you can stay in the stock market for all these things that I talked about. If you're interested in real estate, you can buy REITs. If you're interested in bonds, you can buy ETFs like TLT. If you want to buy precious metals, you can buy ETFs like GLD and SLV and things of that nature. So you have all aspects of the trading competition within the stock market itself. And you have one more advantage too. You could short these things too with what they call inverse ETFs. So the stock market gives you a whole range of choices to take advantage of anything that's considered, what I would consider competition from just buying an index, if you will. And the last thing I'll talk about is the cost of money. If money costs too much, you may just determine that I want to pay down debt instead, or companies aren't going to be able to buy back shares, and that will limit their value of their company, because it's really essentially supply and demand. When they sell shares to the public, it dilutes the value of the company if they don't put that cash to work, if they pay it out as a dividend, and vice versa. If they take the excess cash that they're generating or borrow money against the assets of the company to bring back shares in, they're reducing what they call the float. The float is how many shares are floating out there in the public. And then that obviously supply and demand lifts value. But if the cost of doing that becomes too much, they're going to either sell shares back out or they're going to stop doing it. It's going to affect the value. So that's another thing you have to be aware of when you're in the stock market trading. So, who really moves the stock market? And I put 4 categories together. One I call the robots. The robots are the rise of the high frequency traders and the algo traders, and they're really goal seeking. They have targets in mind that will drive them towards a direction. But there's also robots that are out there that say, hey, if things are moving in one direction too far, I'm going to push it back towards a center of gravity. So these are these are trading mechanisms that have what I call no remorse. They are simply mathematical constructs. And if you ever wonder when you watch the stock market, saying, I just can't believe it won't go down. No trade all day long is moved at all. Well, when people were trading exclusively, it moved up and down because you had emotions involved. So when you have robots doing the trading, they have no emotions. They don't get scared. They just look at everything from a mathematical algorithm and say, yep, I got to buy more. Yep, I got to buy more. Yep, I got to reverse this. Or now I'm done. And that's where these flash crashes come from, because they just get done. And a lot of people are leaning on the same kind of algorithms, and it creates these vacuums in the market. The other thing is are what I call the whales. Now the whales use robots, okay? And they also have their own people, but the whales are the big money. Those are the big banks. Those are the big hedge funds. Those are the big pension funds. Those are the sovereign wealth funds. And those are the central banks. These are the people that they don't worry about where the market's going to go. They're taking the market somewhere, okay? These people don't wake up in the morning and say, I wonder if oil's going to go up today. They wake up in the morning and say oil is going to go this direction today, because they're making it happen, okay? And so, when you're trading, you need to know who you are, because if you're not a whale, you're following. And there's 2 kinds of followers, what I call the seagulls and I call the sheep. The seagulls know about robots, they know about whales, and they have a plan of attack. They're happy to let the whales and the dolphins bring the fish up to the surface, and they just sit up there top of them and wait for the fish to boil up, and they just pick off the profits. They know they can't move the market. They're following, they're watching, they have a plan. And we like to consider ourselves seagulls. We have a plan. We've seen how the whales and the robots like to trade, and we like to then join that move for a short period of time, take our profits, hop off before they decide to take it in a different direction. The other one are the sheep. These are the people that wake up in the day, they're nervous, they don't know what's going on, they wonder what's going to happen, and then they react. And the robots are set up. These guys have PhDs, not only in mathematics, computer science, and physics. These people have PhDs in human psychology. So these robots set people up, okay? And they even fool professional human traders too. And so you may see something that may just look really, really incredible, and not know what just happened to me, just reversed on me. Well, it's because the robots and the whales set you up, and so you kind of have to know who you are. And our goal with helping you trade here is to move you from a sheep to a seagull. If you become a whale, then I'll come work for you, and and we use some tools, robotic tools, in our trading, but they're not like those kind of robots. We're human intervention, but we're using signals and things of that nature. So anyway, I just want to kind of get you a sense for where you are, and there's a lot of people out there. The only way these guys make money is they have to keep sharing the sheep, okay? And we want to move you to a seagull where once we feed, we can just go off and rest for the day, and wait for the next move in the market. So, just to recap here is that they move the market, they have the inside information, they have the tools, they have their price target, but what makes it interesting and what makes it good for us as seagulls is they don't always work together, and they don't always work in the same time frame. So you get these tensions, and the tension is between goal seeking, and goal seeking is like there's a thing called pivots we'll talk about at some point here in our training. And these pivots have stages where they go up and go down to depending on mathematical constructs. And so, goal-seeking algorithms may want to move from pivot to pivot, or Fibonacci line to Fibonacci line. There's other robots out there saying that we have data that tells us if we reverse these certain areas that we can drive things back down to the pivot in which it came to, or reverse it off the new pivot that it got to. And so you create these waves in the market. And so the market looks like a sine wave over time. It's generally going up over time until it reaches a point where you get what I call peak credit. And then it has to reset because, credit operates geometrically where most things are operating arithmetically. The imbalance gets to be so much that it has to mean revert back down. And so, but over time, you're going to see the market waving, but it's waving higher over time. Okay, and we use that tension between the mean reverters and the goal seekers to create our profit potential. So, when you look at how do they they work, they're working off of basically they buy and sell the edges, and they also average down and average up. Average in when it's going down, they're averaging in. When it's going up, they're averaging out. And so what they like to do is they like to buy on. This is a bell curve here I use this thing on innovativeness, but it works the same way. They're buying in here, okay, and most sheep are over here, okay, and seagulls are over here. So the big money in the robots are here working, okay, and you have the sheep, the seagulls working in here. We're picking off. We've seen what's happening. We're seeing the movement. Most sheep are here, and they're selling out to all these people here. And then the last of the holdouts, the prayers are finally giving up, and then we start all over again. So So that's what we do, and that's how the big money moves too. You know, they have the ability, you know, if you ever played poker, you know, they have the big stash. So they could keep taking a losing position and losing position and losing position until they build up enough momentum and take it forward. So, you know, they have no problem accumulating low, where most people, for whatever psychological reason, is that um, they're not interested in low. They're interested in high, and these whales and robots know that, and so they're accumulating low when everybody's scared to buy, and then when everybody's excited about buying, they're selling to them.